Finding a distressed office building or struggling plaza at a steep discount can feel like the deal of the decade. On a spreadsheet, the numbers look impressive, the upside seems obvious, and the seller is under pressure to close. Then the bank says no, or offers a loan so small that the math falls apart. That is usually when the reality of distressed asset financing hits. Distressed assets in Canada show up in many forms. They can be half-leased commercial towers, stalled condo projects, shopping centers that lost anchor tenants, or businesses operating under CCAA or BIA protection. On paper, these assets often look cheap compared with replacement cost or potential stabilized value. There is real upside here. Investors can buy below market, fix operational issues, create jobs, and bring underused properties or businesses back to life. Yet traditional lenders in Canada, from chartered banks to many credit unions, are often unwilling or unable to participate in this type of deal. The hard truth is that the biggest challenge is rarely finding a distressed asset. It is finding money that fits the risk, timeline, and structure of the opportunity. This video breaks down why distressed asset financing is tougher than it appears, what lenders are worried about, what they need to see before saying yes, and how a specialized firm like Equis Capital Finance can help bridge that gap. Many investors focus on the discount but underestimate how conservative lenders are with distressed asset financing. Traditional banks rely on stable income and clean collateral, so they step back when cash flow is weak, history is messy, or timelines are tight. That is why so many distressed deals stall at the funding stage. Hidden issues inside distressed assets are often more serious than buyers expect. Legal claims, environmental problems, unclear valuation, or missing paperwork can all stop a loan committee from approving a file. Lenders are trained to think about what happens if the turnaround fails, not just the best-case scenario. Successful distressed asset financing hinges on preparation and the right partner. Lenders look for realistic turnaround plans, experienced operators, real equity at risk, and a clear exit. Specialist non-bank lenders such as Equis Capital Finance focus on these situations and can build structures that standard lenders simply do not offer. On the surface, distressed assets seem like a simple value play. Buy low, fix problems, sell or refinance higher. From a lender's point of view, though, these files are almost the opposite of a standard commercial mortgage or business loan. The very features that create upside for an investor are the same features that make distressed asset financing hard to approve. Traditional lenders lean heavily on historical performance. They want stable rent rolls, long-term leases, predictable operating history, and strong borrower financials. A half-empty office building, a receiver-managed plaza, or a business that just missed loan payments does not fit that template. There is little reliable cash flow to model, and the past points to trouble rather than stability. The discount on a distressed property or business also comes from real problems. Some are fixable, such as cosmetic issues, short-term vacancy, or a one-time revenue shock. Others are much deeper, such as a permanent shift in local demand, structural damage, or a broken brand. Sorting out which takes specialist knowledge and time, and most bank underwriting teams are not set up for that level of analysis. Risk appetite is another major divide. Canada's major banks are highly cautious, with internal policies and regulators pushing them to avoid higher risk files. Distressed files often involve tight timelines, court dates, auction deadlines, or construction risks. Bank processes, by contrast, move slowly and rely on multiple committee reviews. The result is a basic mismatch between the speed and flexibility distressed opportunities need and the way mainstream lenders operate. From a borrower's perspective, a distressed deal often feels like a bargain with a clear upside. From a lender's perspective, it can look like a minefield. Experienced lenders in distressed asset financing have seen deals fail in many ways, so they approach every file with an eye for what could go wrong, not only what might go right. Good lenders spend more time asking how a deal can go wrong than how it can go right. That mindset shapes how they view valuation, collateral, and the fine print around any distressed asset. Valuing a distressed asset is rarely straightforward. A receiver sale price or asking price does not tell the whole story. Lenders think in terms of several different numbers at once, including liquidation value, current as-is value, and future stabilized value after the turnaround plan is complete. Those numbers can sit very far apart. Loan amounts are usually based on the most conservative of those figures, not the most optimistic. A borrower may focus on the upside of a renovated, fully leased building, while the lender focuses on what happens if the renovation stalls or leasing takes much longer than planned. That tension sits at the heart of distressed asset financing. Independent, recent appraisals are also vital. Lenders want third-party valuators with no direct interest in the deal and detailed comments on deferred maintenance, lease quality, and local market conditions. For commercial real estate, issues such as contamination, structural repairs, or chronic vacancy can pull value down sharply. The gap between what an asset could be worth and what a lender will lend against is where many distressed asset financing proposals fall apart. Legal and structural risks are another area where lenders take a more cautious view than many buyers. In Canada, Personal Property Security Act searches show existing liens and competing claims on business assets, equipment, or receivables. If several parties already have security registered, a new lender may not be comfortable with their position, or may demand much stricter terms. Environmental exposure is a significant concern, especially with industrial, retail, or older commercial sites. Undisclosed contamination or incomplete reports can scare off lenders, because cleanup costs can exceed the property value and can drag on for years. No matter how promising a turnaround story sounds, few lenders want to inherit that kind of risk. Lenders also review any active or potential litigation, union or employee claims, long-term supplier or customer contracts, and the terms of CCAA or BIA filings and court orders. These obligations can survive a purchase unless the sale runs through a clear court process with vesting orders. Files involving CCAA or BIA proceedings may offer better legal clarity but come with strict timelines and procedural steps that some lenders simply are not prepared to manage. Distressed deals are often lost in the legal schedules, not the financial model. After all the reasons to say no, it helps to understand what a lender needs to see in order to approve distressed asset financing. While every lender has its own style, the underlying questions are very similar across the Canadian market. The starting point is always the asset itself. Lenders look at how easily they could recover their money if the turnaround plan fails. That brings the focus back to current value, quality of collateral, and liquidation prospects. A clean, well-supported appraisal from a respected firm is usually step one before deeper discussions move ahead. Lenders want a clear written roadmap for how value will be created and risk reduced. That means specific capital budgets, timelines, lease-up or sales strategies, operating changes, and financial projections. Overly rosy assumptions, missing details, or vague, fix and sell language tend to end the conversation very quickly. People matter as much as numbers. An underpriced asset in the hands of an inexperienced operator looks very risky from a lender's chair. By contrast, a sponsor with a history of successful repositionings or restructurings in the same asset class can give a lender confidence. Many distressed asset financing approvals come down to whether the lender believes this team can execute the plan. Lenders expect the borrower to have meaningful equity at risk. Very few, if any, will fund 100% of a distressed purchase and renovation budget. A real cash investment shows alignment, absorbs part of the downside, and signals commitment. Finally, lenders look hard at the exit. They want to know exactly how and when they will be repaid, whether through refinancing with a traditional bank once the asset stabilizes, a targeted sale, or strong ongoing cash flow. Vague comments about selling when the market improves rarely pass credit review. A defined exit is central to any serious distressed asset financing proposal. Hope is not a strategy. A lender's approval depends on evidence, not optimism. Lenders in the distressed space are not just evaluating an asset, they're evaluating a business strategy and the people executing it. This is where a specialist firm such as Equis Capital Finance becomes important. Equis sits in the space that traditional lenders leave open, focused on commercial borrowers and projects that fall outside standard bank guidelines. For sponsors working on distressed asset financing in Canada and the United States, that is often the difference between a stalled opportunity and a deal that closes. Principals at Equis Capital Finance bring more than 2 decades of experience in commercial real estate, project finance, and mid-market corporate lending. They have structured and closed transactions starting at $1 million and scaling into the hundreds of millions across multifamily buildings, mixed-use developments, office towers, retail centers, and industrial facilities. That background allows them to see where the real risks and opportunities sit in a distressed file and to speak the same language as both borrowers and lenders. Equis draws on a wide lender and investor network across North America, including banks and credit unions, insurance companies and pension funds, trust companies, private lenders, and family capital. With that reach, they can match each situation with funding that fits its specific profile, from private and hard money loans to mezzanine or subordinated debt and project equity. For distressed operating businesses, Equis can also arrange asset-based lending, receivables finance, and working capital structures that stabilize operations while a restructuring plan takes hold. Rather than relying on a one-size template, Equis Capital Finance reviews each opportunity with a full underwriting lens. They look at collateral, legal context, management strength, and exit paths, then design a financing structure and lender group that fits the plan. For borrowers facing time-sensitive auctions, stalled developments, or restructuring under CCAA or BIA, this kind of focused distressed asset financing support can turn a complicated situation into a workable transaction. Distressed assets attract attention because they appear cheap, but the financing behind them is anything but simple. Weak cash flow, legal uncertainty, valuation gaps, and tight timelines all combine to make distressed asset financing a specialist field that most traditional lenders prefer to avoid. Many promising deals fail, not because the asset lacks potential, but because the funding request does not match lender expectations. Borrowers who succeed in this space plan carefully. They bring current appraisals, detailed turnaround strategies, experienced teams, real equity commitments, and well-thought-out exit plans. They also recognize that standard bank products are rarely suitable for these situations and instead work with lenders and advisors who focus on distressed and special case files. Equis Capital Finance is one of those specialists. For property owners, developers, and business operators facing a complex or distressed scenario, a conversation with Equis can clarify what is realistic and what structures may be available. Reaching out early in the process can help shape the strategy, line up potential funding partners, and give a distressed opportunity a fair chance to succeed.